Hey guys, we are back live again. It's good to see you guys here tonight. So yeah, we're gonna have, I think, a fun discussion tonight. Everybody at some point needs to sell some investments for various reasons, and I've had to do that before. I've had to sell some investments because I wanted to donate money. I wanted to, invest in a business. Wanted to buy some real estate and had to pay taxes one time, so I needed to sell some stuff. So there's all kinds of reasons that people need to sell some investments to raise cash and get that cash to either uh, resolve an obligation that you have or to carry out some kind of plan that you have outside of your investment strategy. So I wanted to share a little bit about that tonight. I went through that process actually today, so it's very fresh on my brain. I want to talk about, what the thought process was around that. Hopefully it'll help. And if not, it didn't cost you anything. So, but before we get started, I wanted to see Steve C here has said, so upset about the beehive. Sorry to hear this. Will it affect the new business? So, I thought I would give you guys a few minutes on that. I know it's kind of fun to talk about these bees. And it was, pretty sad. So just so you know, I came out of the winter with 3 hives here on the farm and had grown those hives to be 8 hives. So I had over doubled the size of the apiary. And, I'd purchased some packages and also caught some swarms. And so things were going good. And a couple of things. One is we were gone for, as you know, for a while at the beach. And I think one of our hives went queenless for whatever reason. She either died or I'm not sure what happened. But so anyway, they were not growing any new bees. And then I came back. I saw that they were weak, but I was like, well, maybe they will, come back. But they did not. It was a sad situation. So I lost that hive. And then there was another one, which was a swarm that I caught actually out in my pasture in the grass. I may have shown some pictures of that on a live stream. It was one of the wildest things I've ever seen. These bees came up out of the grass. It was like some kind of scary movie, man. So anyway, so I was really excited about that particular swarm. As you guys may or may not know, one of the biggest enemies of a bee population, a bee colony, is some terrible critter called the Varroa destructor. That is the Latin name. It's called the Varroa mite. And as a matter of fact, I didn't even plan to do this, but one of the things that I think about a lot, you probably can't hear me with that in front of the mic, but one of the things I think about a lot is how do we handle these Varroa mites and testing for them and how do we treat them? And there's all kinds of ways to approach that. And I don't want to bore you with all of that. But one of the things is that since that is the biggest enemy, it is the biggest responsibility of a beekeeper is to determine how they're going to treat for mites. So I decided this year I was going to use a particular product. Once all the honey supers were off the hives, then I could use some treatment. And I went ahead and put that on the hive, and including the swarm, which may or may not have been a good idea because they were so new to the apiary. They had not really technically made it their home yet. They were just residing there. They had not built up enough comb and things like that to make it their own place where they would hate to leave, right? So I put that treatment in there. It is not the most pleasant thing for bees. It doesn't hurt them. It just kind of slows them down. It does affect them a little bit. But, the issue is that this mite is a bug. and an insect, and a bee is an insect. So how do you kill a bug on a bug? It's a really difficult thing to do. So anyway, you have these treatments, and they some hives just don't like them. So the second that hive that I caught as a swarm, I think they decided that it just wasn't worth it, and so they left. So the first hive I think died out. The second hive I think decided, hey, that strip of chemical in here is not what we had bargained for. So they left. So now I'm down to 6 hives. The hives that I got my honey off of all are doing very well. I've got 3 hives in a different location that are doing very well. So all 6 of my remaining hives are strong. And so my goal next year, I'm going to sit down here soon and think about my strategy for 2026. Yeah, I know it's only July, but in the bee world, if you're not planning and doing things in like October, November, you're going to be behind the curve, because February, March comes pretty early in the year. So having a strategy about what you want to do, having the equipment on hand, because if I wait until it's time, then everybody else is ordering the equipment and it's hard to find. And so if I can get ahead of the curve and build a strategy, that's what I want to do. So I'm going to be doing a strategy on bees next year. And one of the things I'm seriously considering is raising my own queens. So if you can raise queens, you can expand your apiary really quickly. And so I'm looking forward to 2026, and I'm looking forward actually to sharing some of that on this channel, because it is going to be super cool. I've seen, learned a lot about rearing queens, and it is fascinating. You guys will be excited about that. So anyway, we are down to 6 hives. So Steve, is it going to affect the new business? No. I have ways of managing that, and it happens, right? I mean, there are just times that bees just do what bees do. And so as a matter of fact, we kind of have to get used to it. I read some surveys. They survey, this may be more detailed than you care about, but it's fun for a beekeeper. They survey hobby beekeepers, sideliner beekeepers, which is those that have 50 hives or more and less than 500. And then commercial beekeepers have 500 hives or more. And so they survey each of those different groups, and they determine what percentage of hives that they had in August of whatever year have died out by February of the following year. And this past year, so from August of 24 to February of 25, roughly half, 50% of the beehives across the board, doesn't matter if you're commercial, sideliner, or hobbyist, about half of the beehives were lost to something. It could have been a pest. It could have been, just getting too cold. There's various reasons that you lose hives during the winter. But I mean, it's just something that as a beekeeper, you have to get used to. You can't avoid it. Sometimes they just don't survive. So I hate to lose them, but at the end of the day, I try to determine if there's something I did wrong, like this particular treatment. I probably won't do that next time if I have a similar situation. But I have these treatments in my other hives, and they're going fine. So, it is what it is, and we will move forward. But my plan is to grow these hives a lot in 2026. So we'll see how it goes. I'll keep you guys updated. So thanks for asking. Thanks for the empathy there, my friend, because, I just hate to see, it's kind of like children. You hate to see them go, but we will survive as a business, and things are going to be glorious moving forward. All right, we got Shannon here. Shannon all the way from Atlanta. So it's good to have you. Billy, he's here for the honey. So, Billy, that was about 10 minutes worth of bees. hopefully that gave you a little bit of satiation there, my friend. Good to have you on the program. Rust Moments, good to see you, man. Yo, right back at you. Fast Eddie, yeah, sorry to hear about the bees. Yeah, I hear you, man. That's it was, you know, I hate it, but the worst part about it is cleaning up the hives and getting everything back to where it needs to be. So Lucas finally made it to a live. I've been watching the latest replays past couple of weeks. Man, that's great to see. I haven't seen you in a while. I know that you were pretty active there for a long while, and then kind of lost touch with you. So it's good to have you back, man. That's awesome. My buddy ex Dividend Dad, he and Rust Moments have the yo thing going on. We got Pat. Pat is with us. Now, Pat, I will tell you, I mean, I'm not a huge fan of the state of Michigan because I went to Ohio State. That's where I got my MBA. And I would rather be in Michigan right now than Northern Alabama. It is smoking hot down here. I mean, I went out, I actually sold some honey just a little bit ago, and I told them I had to be back by this broadcast. So at 7:30, it was still 90 degrees outside. It was, and it's real high humidity. It's just sweltering out there. So yeah, good luck to everyone this week. That is right. I think one of the things we might do is to see which earnings are going to be released, at least out of my model. So Lucas says, hi, all. Not totally related, but I remember picking tips one season, and there was a bit of snow on the ground, and I stepped on some snow-covered bows, and a couple of hornets came up and stung my ankles. Wow. Yeah, I hate those. Those were probably yellow jackets. Hornets are actually up in a tree in a paper-looking hive, but the yellow jacket actually burrows down in the ground, and there may be some hornets that do that. I'm not really sure, but the typically anything coming out of the ground is a yellow jacket, and I hate those things. They're just a pest. So anyway, sorry to hear about that, but glad to hear you got over it. How's that sound? All right, Michael Swami is here. It's always good when Michael's here. Glad to see you, man. Yeah, sorry to hear about that myself, but life moves on. Legendary is here. We are doing great tonight, man. I'm having a great time here. Things are moving fast. Yeah, good point, ex-dividend dad. Fail forward with this B situation. You got it, honey. I always have to. I should always read yours before I put them up on the screen, but I'll learn one of these days. All right, 50 in the morning, mid 70s during the day. Pat, I would love that, man. It is. I don't know what the temperature is. Let me look at my phone. Here, I'll show you. Look at this. See if I can put it up here. So, can you see that? No, probably not. Well, it's not going to focus on it. Anyway, I'll just tell you what it says. It says 86 degrees. Guys, it is 8:15 at night here in Alabama. It is still 86 degrees. That is ridiculous. Who would move to Alabama? No, I'm just joking. You gotta put up with the good and the bad, So I'm trying to get this back on the charger, but anyway, my case is a little thick for the charger to penetrate, and so I had to be just right on there. All right, let's see. Lucas, back trying to get back in the swing of investing and being active in the community. Man, that's great. Glad to have you back, and so we're always here, man. So when you just need a little bit of encouragement or talking you off the ledge, maybe that would happen. So just swing by, man, and don't forget the Discord. If you, I don't remember if you're in the Discord or not, but if you're not, it's in the notes to this, what is this called? Program? I don't know. Live stream. In the notes to this live stream is a link to the Discord. It is free to join. And I've been actually a little more active lately just because I'm not processing honey anymore. I've got a little bit more time. So it's been very good. Yeah, my friend, I don't do well. I am not built for this temperature. Let me just put it that way. So, well, hey, let's go to what was I going to talk about today? Oh yeah, let's go to let's go to this thing here. We're going to add that to the stage. Maybe. How's that? Oh, there it is. Awesome. So we're going to talk about selling stocks to raise cash. What should you do? How should you approach it? Well, let me just talk about what I did today. I would say it depends. How should you approach it? It depends. It depends on a lot. So here were my criteria for this purchase today. I wanted the proceeds to come from an after-tax account. Now, for you younger folks, this is much more important because, if you go from a tax-deferred account like a Roth or unless you pull your original contribution out of Roth, but you get what I mean, or a traditional IRA or a traditional 401k, you end up with a 10% penalty on any money that you pull out. So I would not recommend that. And even right now, I would rather come from an after-tax account. I just feel better about that. So I wanted it to come from an after-tax account. The second thing is I needed at least 25K. So it's likely that I would eliminate an entire position. Now, for those of you who don't know, let me tell you my rules and why this is true for me. I look to have a normal position in a stock at 2.5% of the portfolio. Portfolio is actually getting close to 1.7 million right now. So 2% is 34,000. So if I needed 25, it would only leave me with 9 if it was 34,000. And that would be much lower than I want to have. I want to have no less than 1% of the portfolio in any investment that we have. If I don't believe enough in it to put 1% of the portfolio in, it ain't worth it. So it would cost, it would actually drag a lot. And I know I could have done this through a whole lot of investments, but I didn't want to do all of that legwork and do all of those transactions. So I want it to be one position. I want it to be out of an after-tax account. And I had a few options. These are not stock options. I should have reworded this. I had a few potential stocks that I could get out of. These are not stock options. One was COP, which is ConocoPhillips, has a market value of $33,000, and my total gain or loss at the time was about $3,000. My second option was Verizon. Verizon had a market value of $34,000 and a total gain of $3,000 in the portfolio. I had T. Rowe Price. Now, T. Rowe Price was at $21,000 in the portfolio, had a gain of $4,000 on it. Last but not least is U.S. Bank, U.S. Bank Corp. I had $44,000 market value with a $10,000 gain on that particular stock. So why do I include the gain on here? Well, it actually helped make my decision for me because earlier in the year, I sold off some shares in some companies to make way for other investments I wanted to make. And so I had some realized gains in the portfolio. So if I had sold off any of the stocks that had unrealized gains and realized those gains, then I would be increasing my tax burden at the end of this year. So what I decided to do is sell off the ConocoPhillips investment. And it's not that I don't like ConocoPhillips. It's that I wanted to harvest that unrealized loss so that it would help offset some of the gains that I had earlier in the year. So I wanted to, I kind of giggled when I saw this. Let me see. Lucas shared he took some nibbles on ConocoPhillips lately. Thoughts on it? So let me just say this, Lucas. I think ConocoPhillips is the best thing going when it comes to petroleum, the oil and gas companies. I like ConocoPhillips. I don't know. This part of the challenge I have with that sector, not with the company, but with the sector, is what is the drill baby drill going to do? And, is the economy going to heat up? And if it does, then maybe that's a good thing for the companies because they'll need that volume. But if there's a lot more volume of supply and the demand stays the same or goes lower, could drive prices lower, which would then drive margins lower. And so I'm kind of waiting to see what goes on there. If I were buying ConocoPhillips right now, it would be nibbles. It would be, or dollar cost averaging. I think that would be a great way to get in. Do I think it's a good value? I think absolutely it's a good value. I just don't know in the short term what's going to happen. I think long term, it's a great buy right now. So if you're a long-term investor, I would say absolutely. I was going to keep it until this issue came up this past weekend, and I needed some cash. So this was my approach. And what else do I have here? I got something else. Yeah, so it was sitting out at a loss. I already talked about all that. So the takeaway to this is everybody that needs to raise capital from time to time or raise cash from time to time has different needs. Their facts and circumstances are different. And so you need to come up with your own criteria. What's important to you? And then once you can kind of lay out those things that are important to you, then you say, okay, what are my options? I've got 4 options, and you pick the one that you think gives you the best value. So in this case, I was able to raise the cash and reduce my future tax burden. So that's what I did. And it really was not about whether I believe in ConocoPhillips or not. It was that I needed some cash and I needed to get rid of an investment to do it. So there you go. Let me know what you think about all that. I just thought I'd share also the honey picture. This is a 2025 honey harvest. So it is, and it's delicious, by the way. It's some of the best honey that I've ever had. So maybe I'm biased. Who knows? All right. So hopefully that was helpful. And let's see. Michael says Hornets and Yellow Jackets are awesome creatures. Yeah, man, I don't like either one of them. And I don't like red wasps either. Honeybees, I'm very good with. My bees are pretty gentle most of the time, unless I do something stupid like I did last week, and they did not. They told me they were not very happy with me. But anyway, they were most of the time pretty gentle. That 50 in the morning, 70 in the evening, and it will describe our winter. Yeah, absolutely, man. It is, you kind of, the winter up north. Now, remember, I used to live in northeast Ohio, between Cleveland and Pittsburgh, and it was bitter cold, lots of snow every year. And here's what I found out. So if you're living in that type of temperature, then you are in the wintertime going from a heated facility to heated car to heated facility. So you don't stay outside long. You go from, your house to the car to the building, the office, and office back to the car to the restaurant, so you're searching for that heated space. And in the summertime, you're outside, you're doing things that you enjoy because the weather is fine. Now, it's just the opposite down south. We go from air conditioning to air conditioning in the summer. So we walk out of the house, get in the air-conditioned vehicle, go to an air-conditioned office or whatever. And in the wintertime, we get to really do some fun things because the weather is very pleasant. So anyway, there you go. That's neither here nor there. But all right, ex-dividend dad says, and obviously I didn't read this, so we'll see what he says here. My story for tomorrow is that we have some war machines providing some earnings tomorrow morning. Also tomorrow, we have Capital One, first earnings since the merger, and we also have MSCI, Coca-Cola, CB, which is Chubb, and PM, which is Philip Morris. So, yeah, no, I think you're exactly right. When we look at the earnings calendar here in just a few minutes, we will see that there are a lot of earnings this coming week, and so yeah, we got a big deal going on, and the war machines I think are gonna, maybe should I predict? Should I not predict? I think the war machines are going to come in pretty much on target, maybe just a little bit better, because it's kind of hard for them to increase, increased volume from one quarter to the next. Now, over the long term, they can, because they need to build facilities, they need to build tooling, they need to build skills to actually increase that level of production. It's not like they are making donuts and they can make donuts faster, right? It's they're making war time equipment, and it's not the easiest thing to do. So I think the quarter is going to be fine. I think the real movement, if any, will be in what they say their future growth projections are. So yeah, we'll wait to see what happens there. But yeah, that's a good point. It's going to be a great week, and I'm going to show you at least the stocks I'm tracking, which ones are reporting this week, and there are a lot. So Trevin says, any thoughts on railroad mergers? Supposedly, Union Pacific wants to merge with Norfolk Southern. Yeah, I'm not big into railroads. It's not that I don't like railroads. I think they're fine. The thing about mergers, here's the thing about mergers is there needs to be some kind of value for the merger, and most of the time it's I've lost the word. Anyway, where they are getting less and less competitors in the market. Somebody help me with that word. They're eating up their competition. They're buying up their competition so that there's less and less players in the market. That then creates a better value moving forward for the company. Not only do they get the research development and the IP, the intangible property of the competitor, but they also get their business and they also get that market share. So that's one reason to do a merger. I don't know, Union Pacific, Norfolk Southern. I'm trying to figure out, and obviously I'm just kind of thinking about this since you asked the question, so I haven't done a lot of research on this. What is the synergy in this particular merger? I mean, they have equipment, right? They have rail availability, and but I don't know. It's not like they can use that equipment and rail availability to create more volume. The only thing I can think of is that they would be able to reduce admin jobs. Like instead of having two CEOs, they would have one. Instead of having two CFOs, they would have one. Instead of having two audit staffs, they would have one. So there would be some benefit there in reducing costs, but I don't know what the business synergy would be. So if anybody's got any thoughts on that, let me know. The Union Pacific Norfolk Southern merger doesn't excite me any. Here's what I do know, though, Triven. Whoever the acquirer is, 90% of the time will go down in value immediately after it's announced. Whoever the acquiree is, the person who is being bought, will actually go up, pretty soon afterwards. And why is that? Because the company doing the acquiring has to pay a premium to entice the shareholders of the acquired company to agree to vote for the merger. So sometimes they even pay, and then they'll come up with some accounting shenanigans to kind of make all this work. But sometimes they will even pay more than it's really worth so that they can get that deal to be approved. So the company that's being bought will get a boost in value because the share price is going to go up. And the company buying, because they're buying something maybe at premium value, is going to come down. So that's the thing to keep an eye out for. I don't know that in the long term, I don't know that Union Pacific Norfolk combination really drives the needle that much. I can't think of any synergies there. If you guys know of any, let me know. I'm happy to kind of toss that stuff around a bit. Let's see what Russ says here. Did you see BRK's BNSF wants to buy CSX? I'm assuming that CSX then would be up after hours if they're going to be bought. So, yeah. Oh, let's see. What do I think about? Hello, Hassan. I don't know if I've ever seen you here before, my friend. Good. Welcome to the program. Glad you're here. What do I think about ConAgra and General Mills these days? Well, for that one, I need to get a drink. Now, today I'm sporting the blue Stanley mug. It is what I can actually put on my tractor, and it goes nowhere. It sits on the fender. I've got a holder out there, and so it is filled with water with one of those lemon Mio squirt things in it. But when my voice dries out a bit, it's nice to get a little swig of water. You know what I mean? So ConAgra, I was reading something about ConAgra right before the program here, and here it is. I'll pull it up. Here, let me share this with you. That ain't helping. How's that? All right. Yeah. It's bad when you're your own production manager, you know. I would fire me if I could. So ConAgra struggles to regain volume amid cost pressures and shifting consumer trends. Simply Safe Dividends has decreased. Let me make this a little bigger so you guys can see it. They have decreased the rating for their dividends. Now, it's not much. They went from 41 to 40, but the biggest news here is they have downgraded them from borderline to unsafe. So I think that says a lot about ConAgra. Let me look at some of the financials of the company. They've lost over 35% of their value in the past year. So I get where you're coming from, Hassan. I think, we look at that and we go, wow, they dropped over 35%. Can I get in, or are they going to go back up that 35%? I don't know. I mean, obviously it could happen. Their earnings payout ratio for the next 12 months looks to be about 80%. That's a little high. Here recently it was 61, which was not so bad, but it looks like business is trailing off. They remain stretched. They've got a BBB minus credit rating, which is just the notch above junk status. So I would say if you're going to go at ConAgra, let me take a look at just their financials. Yeah, they haven't had any dividend growth in a bit. It's been maybe a year or so. They've had 7 years without a reduction. Let's look at some of the financials. Let's look at the payout ratio. We saw that on the previous screen, 80%. Let's look at some of the other things that are kind of fun. Their sales are flat, actually decreasing from 2023, 2024. Return on invested capital is a measly 7%. And let's look at their debt. Their debt to capital is not terrible, but they don't have a great interest coverage ratio. It's only a 4.01, and the target would be 8 for that, which means that they would have earnings, 8 times earnings to pay. They only have 4 times earnings to pay for their interest coverage, which is a little lower than we like. So I would say if you're going to go after ConAgra, that you do it from a speculative perspective. Let's see what Morningstar says the value is. It's trading at a 28% discount. Fair value, according to Morningstar, is about $26, and so it's trading at $18.75. So, but the question is, how long? If that is true, if that fair value is accurate, how long do you have to wait for that to come back? And I think they're in a bit of a pickle now, especially with all this stuff going on with corn syrup and stuff like that. So I think there's some things that I would really want to research before I dived into ConAgra. General Mills, I used to own General Mills. I got out of that business because it just didn't grow very fast for me. It wasn't. There were other companies that had better growth trajectories. I really had it more for a dividend play, but even then, I mean, let's see what their dividend is now. It's been probably 2 or 3 years since I've owned it. Yeah, they're at about a 5% dividend yield, which is a lot higher than when I owned them. Let's do some more. Hey, this is fun. Let's do this. As long as I'm having fun, that's all that matters, right? So General Mills overview. Let's look at a 3-year look. Yeah, I sold it somewhere. I don't remember when I sold it. I could look it up, but that wouldn't be any fun for you guys. I sold it somewhere in here, and it is now way down here. So it again is probably trading at a discount. So let's check it out. General Mills. Yeah, 21% discount. Fair value is $62. So I think in both of these cases, I think you see General Mills with a lot of sugar cereals and things like that. There's a lot of sugar cereals and stuff like that. I think they have a bit of a hill to climb in finding healthier options that are going to provide the margins that they need. So just as he says here, General Mills' portfolio of brands should help restore growth as consumer headwinds ease. So, Morningstar saying the consumer headwinds are going to ease. I'm not sure how fast that's going to be. I hope that's the case for them. But those are my thoughts on them. I'm not wild. I don't know if I don't think I track either of these. Let's see. ConAgra is not in here, and General Mills is not in here. So they're not companies that I'm interested in owning at this point. So I don't track them, and but those are my thoughts. Hopefully that helps, Hassan. It's about time mergers started to be thought of. Yeah, no, I think that's right. I think there is a place for mergers, and I like mergers when they make sense. I just don't know if the Union Pacific Norfolk Southern one makes a lot of sense. Red Wasps. Yeah, you may not have those up there, ex-dividend dad. But they are, when they sting you, you know it. It's probably about this long. It's a big old wasp, and they call them red wasp. Actually, down here, some people put a on the end of it. They're red waspers. So, but technically, it's a wasp. So, new marketing campaign: a bee on every bottle. LOL, like the tequila. Oh, the bee in every bottle. That would be funny. I'm not sure that I would sell much honey that way. People don't take kindly when they see bee parts coming out of their honey. So I like the idea, Steve. You keep thinking, man. We're gonna land on something good someday. One thing to watch out for, though, is TXN. I dislike the free cash flow this company has, so I'm waiting for a drop. Yeah, I'm out of TXN. I own a little bit of TXN through SOXX, which is an ETF for chip companies. But yeah, I agree with you. I think there may be another shoe to drop for them. So we'll see. So you got a good point there. Dobo Zips. It's good to see you, man. I don't think we've ever met. So welcome to the program. I'm glad you're here. Thoughts on Pfizer? Fidelity has it at a very bullish and currently dividend yield of 7%. So dividend yield sometimes gives you a clue. I'm sorry, I need another swig. When you got a dividend yield that's really high, something is wrong. And because the investors are saying they would rather not have an above market dividend yield because they're not willing to buy the stock and raise the stock price so that the yield will come back down to something normal. So typically the investing market will say there's something wrong. So let's take a look quickly at Pfizer here. I'm going to pull up, before I switch over, I'm going to pull up Pfizer's, I'll switch you guys back over so you can see it. So I'm not lying to you, which I would never do. It says fair value of 38, so they're trading at a 36% discount. So that's pretty good. 5-star rated stock. Seems to be some long-term value here. The question is how much? Pfizer, they think the competitive advantages still exist. Signs of erosion weigh on our valuation. So there is some erosion coming from their patent expirations and all of this COVID stuff going away. So there's still some erosion that's happening there. And I think that's a bit of a challenge. Let's see what this says about that. So right now, Simply Safe Dividend says it's a borderline safe. Dividend is 7%, 7.09, which you said. Dividend growth is not terrible, 2.4%. They've got an A credit rating, so that's good. Let's see what else is kind of fun here. Yeah, they've gone from 75 in April 14th, which is about 3 months ago. They went down to 60. Payout ratio looks fine. Look at that dividend growth. It looks pretty good. See if there's anything else fun here. Yeah, an 8.4 PE ratio. They're at $24.26. Their 52-week high is 31. Payout ratio sitting around 60%. So that's not terrible. Earnings per share, you can see during the pandemic was really wild. But, it looks like over the next year, it's going to be moving downward. Return on invested capital is not great. It's an 8% return on invested capital. And, and their interest coverage ratio is also 5.57, which is a little lower than we like. So, yeah, I'm, I hate to keep saying this. I feel like a broken record, but I'm not a fan of Pfizer. And I know that my friends, I know, I hear the screaming into the screens as you watch or listen to this. But and I know some of my friends are big on Pfizer. I'm just not. I'm not a huge fan. It is undervalued, and if that's what you're looking for, I think that's great. There are fewer undervalued stocks now than there have been in the past, right? I mean, the market has hit all-time highs. So if you're a value investor and you're looking for stocks who are undervalued, Pfizer is one of those, and these other stocks that we've talked about tonight are undervalued. And so if that is your investment strategy, then chances are at some point it's going to come back. But you have to trust management. You have to understand that they're going to be able to pull this off for you. So, I wouldn't be out there buying it at this point. But that's just me. I'm just giving you my opinion. I'm not giving you advice on what to do in your portfolio. I'm just saying that for me, it's not something that I am looking to put in my portfolio. So, but it's fun going down memory lane there. Let's see here. Legendary. I've been looking at Snap-on. Do you mind sharing your thoughts about it? And I'm still looking at Lockheed Martin, waiting for it to go a little lower. Okay, cool. So let's see. Snap-on. I actually track Snap-on in the spreadsheet. I used to own Snap-on. Let me just tell you that sometimes we just don't get it right. We can be the best investors, have the best models, but sometimes we just get it wrong. I wanted to decrease the number of investments that I had. So I had both Stanley Black & Decker and Snap-on. And because of valuation, I picked Stanley Black & Decker. Terrible move. I lost a lot of money in Stanley. And meanwhile, Snap-on just kept growing and growing and growing. So, I hate it when that happens, but I can't sit here and pretend that I always get it right either. So, but anyway, let me find Snap-on here. And I will say that's before I built this model, though. I think I would have picked neither of them had I had the model at the time. Yeah, so Snap-on actually looks pretty decent. Let me share with you what I'm looking at here. I'm going to make this bigger. There we go. You see that? See that Snap-on? So this is my model. You can see that it's in my watch list. I have it rated as a hold, but that doesn't mean a whole lot. If you like it, then it's a buy for you. So I don't have any shares. You see that I say that there's going to be a potential of a 10% return over the next 12 months. The average analyst estimate is a 5% return. So neither of those is terrible. It's got a narrow moat. It is overvalued at 139% return on invested capital. Those 15%, that's not too shabby. You want to be able to invest capital and make money, and that's what they are able to do. Dividend safety is 99, so you can't fault that. They got a dividend yield of 2.6 with a buyback yield of 1.9, so a total shareholder yield of 4.5%. Let's see if there's anything else fun in here. They've got dividend growth. Now, what I pick here for dividend growth is I pick the lowest of either the 5-year average or the most recent. So if they have a 5-year average of 15% dividend growth, and this year they only had 1%, I pick 1%. My model picks 1% because I want to know if and if it's been 5% over the last few years and it's 50% this year, it picks 5%. Because I want to be conservative in my model. So that, I'm showing a 14.5% dividend growth. So that's phenomenal. So yeah, I don't see any issues at all. Other than Morningstar says they're worth 236 and they are currently trading at 328. But if you like the company and you believe in what they've got, I mean, everything else looks great. It just may not be the time to buy it, but who knows when it would come back down, right? So, oh, what was the other one? Lockheed Martin. Yeah, Lockheed Martin. Let's take a look at it real quick. I do own Lockheed Martin and have owned it for a while. It's one of those stocks that I bought because it was way undervalued, and I ended up trimming to get to a normal value, and decided to keep it. I think it's going to do well. So here we go. Shareholder yield. Let's come back over here. So I'm saying 12% annual return potential in the model, and analysts, the average analysts, are saying 16%. So that's a pretty good. I think Lockheed Martin's got some high potential. They are trading at a 15% discount, so they are under their fair value. They've got a 24% return on invested capital and a dividend safety rating of 80, with a 6% total shareholder yield. That's 2.9% in dividends and 3.2% in buybacks. So I think Lockheed Martin looks good. I think they're undervalued. So I think if you wanted to buy them, especially if you're dollar cost averaging in, I think Lockheed Martin's not a bad investment to do. So anyway, it's probably spent a little too long on that, but it's I don't see my buddy Russ on here, so I don't think I'll get any flack if he's not on. So oligopoly, are you talking about the railroads? And it's very possible if they put the if they're you're saying that the word I was looking for is oligopoly, and no, it's not. It is. I'll think about it after the program, but it is when gosh, it's on the tip of my tongue. I just can't think of what it is. But it's basically when they compress the shares, and it doesn't necessarily, oligopoly would be something where there's maybe two companies. So it's when it goes so far, right? But when, it could be, highly fragmented, and then they begin to, can't think of the word. They begin to, man, it is just right there. I can't find it. It's not in my head right now. So, but it's a good guess. It's pretty close. Yeah, railroad network. It's largely southern, it's Midwestern, West. Yeah, that's right. Let me come back over here. You guys don't need to see all of that. Kevin, what did you decide? What you decided to sell was nothing to do with the company, only if there was a tax advantage. That is correct. That is correct, Fast Eddie. If all three companies hadn't made you a penny, which one would you have gotten rid of? That's a great question. So let me just kind of refresh on what my options were. So ConocoPhillips, Verizon, T. Rowe Price, USB, US Bancorp. If there were no tax ramifications for me, I would have picked, drum roll, I would have picked T. Rowe Price. T. Rowe Price is, I think, going to struggle, but the dividend is great. That's why it's in my after-tax account. So I think my first choice would have been T. Rowe Price. Second choice would have been Verizon. They had a great earnings today, man. They've got some growth coming, and the market blessed them today because of that. I think it went up like 4%. So, but I still think my number two choice would have been Verizon. Third choice, USB. Fourth choice, ConocoPhillips. So, yeah, that's a great question, man. Yeah, that's right. And ConAgra, I'm looking for a turn around 0.5% of portfolio. So 0.5%. So in ConAgra, so 0.5% of the portfolio. Yeah, so that'd be a pretty small investment. So yeah, I mean, if diversification is awesome, right? So if you've got 0.5% in a company. I've decided that I'm not going to put anything less than 1% in any company. I'm not saying that anybody else has to do that. I'm just saying that I came to that conclusion for my own sanity. So, but I think if it's a 0.5% and you're willing to take a gamble on it, I don't see anything wrong with it. It's not a bad company at all. Steve says he has both General Mills and Pfizer. As long as they pay the dividends, as long as they show Steve the cash, he's happy. They will have their day like Pepsi and AT&T. Just wait. Yep, that very well could be. That would be awesome. Or at least I hope. He says that's great. All right, so I also agree with sectors taking a hit. It's DeHobo. Okay, not Dobo, not it's DeHobo. DeHobo. The picture of Zippy should be a clue for you. Paths crossed. Akron Zips. It's fantastic, man. So does that mean that you're up in that area? And to say that our paths have crossed, do you actually know me? If so, I'm sorry. Consolidation. That's it, Michael. You are on it. That's why I love that you're here, man. You helped me get through some tough times. So, all right. So one thing else I wanted to show you, we just got a couple of minutes left. And one other thing I wanted to show you is in this model that I have built, so one of the things that there's a couple of folks on YouTube that actually show the real thing when it comes to their portfolio. I think Joseph Carlson does that very well. But most of the others, and I think my buddy Ryan does that well. I don't. There's a lot though that just say what they've bought and what they bought and what they have sold, but they really don't give any performance data. And so here's what I want to show you. All right, so my model picks all of the transactions, every company that I have invested in since April of 2021, which is when I retired. When I retired, I started this portfolio of individual stocks. I was investing in mutual funds, ETFs at the time for various reasons, and I won't go into all of that. But what I decided to do was I didn't care whether I made money or lost money. I wanted to be able to just be real and transparent about my portfolio. Let me get Michael's comment off here. Maybe you can see more of that. But so you can see on the left-hand side, I mean, these are all the companies that I've invested in over the last, what would this be? This is 2025. So about 4.5 years. And if you look at the top here, you can see the number has been 117 companies. And it's, the reason is that I was really learning, right? I was learning how to be a good investor, actually. So where I'm at is I've got these categorized where I've got companies that have gained me greater than $10,000, companies that have gained me between $500 and $10,000, and then some that I consider to be noise, meaning that they didn't really make or lose a lot. It's between minus 500 plus 500. Then I've got a minus 500 to 10,000 and greater than 10,000 in losses. So we can see here that in total, I've invested in the last 4.5 years in 117 companies. I currently have 24. So this is the entire population. This is the open positions that I have. You can see that there's 56 of these companies made me more than $500. There's 51 that were noise, basically between 500 loss and 500 gains. So it didn't really matter. As a matter of fact, you can see here the total gains and losses of those 51 companies was a little less than $2,000 in gain. And then I have 10 companies that that lost more than $500. So I had 10 companies that lost more than 500. I've had 56 that made more than 500. So that's not a bad track record. Currently have open 4 companies who I have losses of more than $500 on, and 1 company which is kind of a break even. And then I have 19 companies who are gains of $500 or more. And I think this is a really good picture of not picking your weeds, not picking your flowers and watering your weeds. I think you want to get rid of your weeds and grow your flowers. So anyway, hopefully that's helpful. Yeah, I used to own AGNC. Yeah, believe it or not. That was when I was first learning about dividend investing, and ended up getting into some yield traps, and fortunately was able to get out of a lot of those. I didn't invest in a lot of them, but I did have AGNC. You can see that. I lost $166. I got $25 in dividends, so the net of that was a loss of $141. It's one of these 51 stocks. And I consider that a like tuition, right? So when you go to school, you got to pay tuition, and in this case, I paid $141 to AGNC, or to the market, to teach me a lesson, and it taught me a lot. So, but the other cool thing here is that you can see that the portfolio has grown since April of 2021 by over $500,000. Unrealized is 362,000, and that's even after today. Realized gains of 50,000 and dividends about 132. So this is also why I like to tell folks I want not only to have dividends but also to have growth. I think growth is really important. So I'm really pleased with how the portfolio has performed. I do want to say I don't always get it right. I mean, I've had 10 companies that I've lost more than $500 on. Some I've lost quite a bit on. So, I mean, you can see here my total losses that are 500 or greater is 100, and what does that total up to be? $137,000. But my gains over $500 are almost 680,000. So I just want to be transparent. I want to be open about all the transactions that I've done. And I don't make a lot of transactions now because I have built my rules, I've built my model, and I buy and sell when I think it's appropriate. I actually calculated the other day how many buys and sells I've had, and it's not a lot. So I don't know why I shared that, but I just thought somebody needed to see that. And oh man, I am so sorry that yeah. Hopefully it wasn't too bad of an experience for you, D-Hobo. All right. Any thoughts on putting cane sugar in Coke instead? I think it's a great thing to put cane sugar in Coke. When we go overseas, that's what they use. Guatemala, it's what they use. So I think cane sugar is not great. It's not healthy. We don't need to be drinking sugar anyway, but it's much better than high fructose corn syrup. I don't really drink a lot of carbonated drinks. I might drink maybe 2 Diet Cokes a month. So I don't drink a lot of carbonated drinks. I drink a lot of water. I drink a lot of tea, but I don't drink a lot of carbonated drinks. So anyway, I've got to get off here, man. We are over time. Let's see if there's anything. This is great. Good. So Michael says he owns Coke, but he won't drink it. That's fantastic. All right. Well, guys, I am going to step off of here and go relax for a little bit. So I hope you guys had I hope it was helpful for you guys. Give me some feedback if you would. And We will see you for sure next Monday. I do have some ideas for some edited videos, so if I can get a little bit more time, you might see some edited videos on some stocks that I'm researching at the moment. So stay tuned and subscribe if you haven't. Join the Discord; it's free. The links in the notes below, and I will catch you guys on the next one. Hope you have a great week, everybody.